Trey, you want to
Sure.
come on up? So we got two awesome speakers here today, this evening. We are going to lead off with Trey Palmedo with New Point
Yeah,
Real Estate Capital. Is that the
that's the new
exact
one.
name
Yeah.
of it? And Trey has been in the finance world, especially in the Fannie Freddie. There's a term that if you're new, you'll hear about conventional lending, but then you'll also hear about agency lending. So Fannie Freddie, that kind of stuff. We're gonna get into that because that's what Trey concentrates on. So we'll talk about qualifications for that and all that good stuff. But Trey has been in the business for a number of years now. We've known Trey, great guy. He was also named one of the top 30 under 30, here in Nashville. How many millions did you do last year?
Last year,
Anyways?
probably close to 350 million
Yeah, so
last year.
just a small number. So from that standpoint, but and we really appreciate him because he's taken on a new role with his new company. He's kind of overall the Southeast, so it's added lots of travel to his schedule. And so I know he was in New Jersey and then New York and down in Mississippi, and then he drove from there to be here this evening with us. So kind of a road warrior. So we really appreciate him being here in person with us tonight. So is there anything more that you want to cover about your background before we get started on?
Actually, I want to start off. I'm going to plug Billy Joe one more time. So I've actually referred multiple clients as well to Billy Joe, and as an agency lender, we look for. And I think we're going to talk about some of these, but we look for qualifiers inside of our sponsorship, and one of the qualifiers is 2 years of ownership experience. But even then, typically within a subset of rules, we're hoping to get a good third-party property manager. And what we really love are property managers that are not new to us as agency capital providers. And Billy Joe has always done a fantastic job inside of the closing process from a debt perspective of doing all the things necessary that property managers do as we go through a loan. So I'm sure Brian and a lot of folks here that work with her on the management side can say wonderful things about her as she manages their properties. But I would also plug from the closing process and the debt side of doing stuff that Billy Joe's always done a fantastic job. So very grateful and wanted to plug her one last time. As far as my background goes, I would say I can do a quick background. I graduated from Auburn University back in 2015, which doesn't feel like 8 years ago, but somehow it was. I started my career as a banker for the Swiss bank. I was a trader, did not fall in love with it, came over to multifamily, started off as a mortgage broker. So basically finance the whole time. I was in mortgage brokerage for about a year and a half. Then I took over as a direct originator, which means instead of clients going to me and me going to lenders, clients would come to me and I was the lender. Took over for a group called Hunt, which was a large lender that wanted to expand their operations to Nashville, started their Nashville office. And in 2022, the office that I started in Nashville became the second largest production office for the firm. And it was a $40 billion balance sheet firm. So it was pretty sizable, close to about $1 billion while I was with that firm. And then about 3 months ago, the former CEO of Freddie Mac, David Brickman, who is now running a new bank called New Point, called me up and asked me to do something very similar with this firm. And now I've started our new division here in basically the Southeastern platform for a new bank that is backed by one of the largest capital groups in the world called Meridian and Mass Mutual, which is an insurance company, a sort of joint venture between those two to start a new Fannie Freddie DUS lender. And we are on the map. And this is a real stat. We are the fastest growing multifamily shop in America, and we've done that in 2 years. I think we went from doing like $100 million in year 1 to $4 billion in year 2. So that's what happens when you hire the CEO of Freddie Mac. But we are rapidly growing, and we have good aspirations for the firm, and good aspirations for multifamily financing in general. So that's me professionally. Personally, I have 2 babies. They're the loves of my life. And my wife, and travel a lot, play terrible golf, drink wine, and eat too much. That's it.
Yeah. So, all right, well, we're gonna jump in. We're gonna talk about the agency side, because I know we have some people here this evening that maybe new to financing when it comes to real estate, maybe trying to understand, okay, what's conventional, and then you have the agency, so how would you best describe when somebody says, hey, Trey, what's agency? What's different between agency and conventional?
Yeah, I think one of the biggest things is just to understand first where it comes from. A lot of folks, their first exposure to Fannie Mae or Freddie Mac is one of 2 things. Either A, they know about 08, and they know the big role that all the various banks played, and those names sound familiar to them because I heard about them on the news. Or B, they've closed their single family mortgage, their personal mortgage, and it was probably a Freddie Mac or a Fannie Mae loan. If you've ever heard of an FHA loan, that is sort of an envelope term or an umbrella term for various agencies under U.S. government conservatorship, Fannie and Freddie being the 2 largest of those. But what a lot of folks don't know is that they also provide a significant portion of multifamily financing in America. So they're not just financing single family housing, they're financing multifamily housing as well, and have a huge concentration on that market, and lend a very sort of niche product. And what I would say is that with respect to agency versus conventional, is that agency is a little bit harder to qualify for in both property, collateral, and sponsorship. But when you do, it is generally more attractive than conventional. Yeah.
So let's talk about some of those, some of those not only qualifiers, but some of the reasons why people, go with agency. So you hear the term, non-recourse.
Mhm.
So what is non-recourse?
A lot of what conventional financing is sort of what everyone thinks of when they think of a loan. Somebody gives you some money. They usually come up with some sort of due diligence process where they're assessing how you're going to pay that money back. And if you don't pay that money back, they have evaluated you as a source to essentially recover that loss, right? And that's recourse financing, where essentially you and your personal balance sheet and the assets that you own, the income that you make, and the I already said assets you own, sorry. Those collateralize the mortgage. Oh, and the asset that you're borrowing against. All 3 of those things are factored into collateralizing the financing that you're taking, and you can kind of think of that across the board, right? That's housing, that's cars, that's anything. In non-recourse financing, the collateral that you're borrowing against is what finances it. So if the collateral goes belly up, you are not personally liable. Your balance sheet, your assets, your income are not personally liable to recovering that asset, that loss to the bank. It's useful if you think about it, not only just in terms of sort of slightly less risky to sponsorship. It's useful when you're evaluating your own personal financial statement. Typically, if you think about what creates a liability against yourself, sorry, a liability against yourself is something that's going to have a negative impact on your overall financial wherewithal. Whereas a liability just as sitting on the side of your financial statement as debt is a little bit more attractive, and it doesn't create a contingent liability. It creates just a collateralized liability to the property. So a lot of different words. Long story short, recourse financing is financing that is collateralized by you and your assets and your balance sheet. Non-recourse financing is collateralized only by the property and only by that specific property. So if one property goes belly up, you have 15 other properties. If one goes belly up, you lose that property, you lose that financing, but your other 15 are safe.
So, yeah, so that's key to understand, right? Because a lot of times when we talk about, recourse versus non-recourse, one of the main advantages with agency is that it's non-recourse, right? From that standpoint. Now, because it is non-recourse, Fannie and Freddie are very, I don't know if you want to say picky, very on their requirements, meaning they come out, they not only, if I'm buying the property, I'm hiring an inspector to come out and inspect the property and everything else. Fannie and Freddie's gonna send somebody out to also walk through and take a look at that property as well, right? So I think I don't even know what the number is that Fannie and Freddie actually takes back, but it's like
Yeah.
what, 0.00001?
Yeah, it's phenomenally low.
Yeah,
It's phenomenally low.
very low because, they do a great job on the front end, not only in underwriting the property, but also underwriting you as a buyer, right? And taking a look at who you are, and then there's certain requirements which we can get into as far as, there's 2 years of ownership. You have to have, and what's the net worth kind of?
Yeah, so your net worth needs to be equal to or greater than the value of the loan. Your liquidity is roughly 10% of the loan, and you need to have at least 2 years of ownership experience of a like-sized asset to borrow from the agencies. But this is something we've talked a lot about before. This is evaluated as an entire general partnership. It's not just a singular individual. So if you're in a general partnership of folks that are purchasing a partnership together, your net worths are combined, your liquidities are combined, and only one individual inside of that needs to have that 2 years of ownership experience or more. So what a lot of folks do, and especially what gatherings like this are useful for, is people will sort of build collaborative joint ventures of folks that meet different criteria, right? You might get one person who's got a very strong balance sheet. You might get somebody that has a lot of ownership and owner-operator experience. You might get someone that has a very strong balance sheet that has a lot of owner-operator experience, but they're used to buying $20 million properties. They want to buy a $50 million property, right? And they need, and their net worth $30 million, and they need someone to stretch that next 20. So there's a lot of different things that you can do to sort of put yourself in the qualifying bucket if you're not already and want to borrow agency. And what I've always told people is that the beauty of commercial real estate versus residential real estate is there's very little emotion involved into it, which all the brokers in here will laugh because it's all this business is, but it's mostly math, right? And you can evaluate. You can say, if I take a piece of conventional financing from the bank and it's going to give me X terms, X rate, X proceeds, versus taking an agency loan, is it worth it for me to delever my general partnership to qualify for a loan that I otherwise wouldn't qualify for, or to take the bank financing? So it's always a pretty easy math problem. And I will say that, I have not seen an instance where we don't come out on top, and I don't say that in like a, we're better at it or salespeople. You look at our amortization rates, you look at our interest rates, you look at our proceeds levels, even some of the bells and whistles like interest only, like we typically are just a completely stronger financing piece for an acquisition or a refinance.
Yeah, that's so when you're, when you hear agency, usually, 2 or 3 things about it is usually the rates tend to be better with agency. Number 2 is the non-recourse, and then number 3 is, let's see, you just mentioned it.
Interest only.
Yeah, interest only. Sorry, that was slipped my mind over. So so you have a certain number of years usually for interest only, right, on your loan. So that's not typical. Any of that is not typical in conventional lending, right? So that's one of the huge advantages. So now on agency, so talk to us a little bit about the difference between Fannie and Freddie. You hear Fannie, Freddie, what's the difference? You hear SBL, small, balance loans. So tell us some of those, explain some of that terminology to us.
Yeah, there's a good bit of differences between the two. It is important to note that they're in competition with each other. So where there are differences, they highlight those differences as strengths and not weaknesses. But the main difference between the two, in my opinion, and what I think most lenders would agree with, is sort of the autonomy over how our partnerships works with each other. So just to briefly back up and talk about the mission of the agencies, they have what Congress calls a duty to serve. Their existence is to create liquidity and provide stability inside of the housing markets, whether it's multifamily or single family. They are under conservatorship of the U.S. government, which means that all of you are backing their risk, and that will probably not change. And the last time I sat in front of at the Reigns Group, we talked for an hour about interest rates and capital markets and conservatorship and Fannie and Freddie, and maybe we can talk about some of that tonight. But the main difference between the two is the autonomy given to lenders over Fannie Mae is a little bit stronger. And the Freddie, we act more as a go-between between the client and the agency. Lenders, we risk share with Fannie Mae. We are part of the capital stack, but in both instances, we service the loans in-house as lenders. So I think for me, what I've noticed the biggest difference is I have a little bit higher of a success rate with Fannie Mae. I think that there's just more creativity inside of the financing. I think Freddie Mac is a little bit more chewier, a little bit more diligence driven. But both are fantastic partnerships for my firm and other firms. And I think that both play a significant role inside of the markets, particularly in markets in the Southeast that really do need a duty to serve to perform in. And then
so SVL versus
yes, So and it used to be that the pricing difference between small balance and conventional, which is an amount, right? Basically, I think something like 10 years ago. I'm not exactly sure when the SBL programs came online. And what that is, those are loans that are sub 8 million for Freddie Mac and 6 million for Fannie Mae. They're smaller loans used to acquire smaller properties. They were finding that it was a little bit cost prohibitive to do a $3 million loan on a property, because you would incur costs that are pretty acceptable costs when you're doing a $20-30 million loan. But when you're doing a $3 million loan, they're kind of chewier costs. So the agencies both got together and said, we're going to make a more streamlined product that's a little bit easier to close. And more importantly, cheaper to close. And so they created what Fannie calls Chapter 9 or small balance or small loan, and what Freddie Mac calls SBL or small balance loans. They created these new products to close smaller properties. For the longest time, they had a significant price difference between the two, between the conventional and the small balance. There was a pretty healthy delta. I mean, almost 50-60 bips. Between the two that would run in parallel to each other. So sometimes you would really be chipping away at getting to a $6 million loan with Fannie Mae. You'd come up short, $5.9 million loan, and you'd be just short, and you would have a higher interest rate. And it was it wasn't an inhibitor, but it was not as fun. They actually recently did away with that. So the difference between the two aren't as glaring anymore. It's just that now I would say, because we have these products, we're still able to close smaller loans from, we have a minimum loan size of $1 million, but we're able to close smaller loans while still being a very cost effective option instead of being a cost prohibitive option.
Yeah. Okay.
So that's really new.
Yeah.
It's like 3 weeks old.
That's it.
Yeah.
That's the first I've heard.
This big thing in our industry.
Yeah. So,